Jerome Powell says banks are perfectly able to serve crypto customers, sending Bitcoin higher and now threatening a weekly closing all-time high. Welcome back to the Bitcoin Layer. I'm Nick Bhatia. Today, the Federal Reserve met. Jerome Powell held his press conference, mentioned Bitcoin and the crypto industry. We'll get to all that. Let's start with what the Fed did today. Now, the Fed decided to keep rates on hold. The Fed has been lowering rates for the past several months. It lowered rates by about 1% and now has decided to keep rates where they are. Why is it doing this? Number one, the reason the Fed started to cut, it was starting to get worried about the economy. Now it is not so worried about the economy. Number two, the Fed sees potential policy shifts that are going to affect aggregate demand, inflation, and growth, and it wants to wait and see what's going on there. So basically, the Fed is in a wait-and-see mentality, but there is a key message underneath that wait-and-see mentality that affects Bitcoin and risk markets. We will talk about that today. As Bitcoin's role in the global financial landscape evolves, understanding its potential impact on your wealth becomes increasingly crucial. Whether we see a measured adoption or accelerated hyper-Bitcoinization, being prepared for various scenarios can make the difference between merely participating and truly optimizing your position. This is why Unchained developed the Bitcoin Calculator, a sophisticated modeling tool that helps you visualize and prepare for multiple Bitcoin futures. Beyond traditional retirement planning, it offers deep insight into how different adoption scenarios could transform your wealth trajectory. What sets this tool apart is that it's integrated with Unchained IRA, the only solution that combines the tax advantages of a retirement account with self-custody of Bitcoin. In any future state, maintaining control of your Bitcoin keys remains fundamental to your Bitcoin strategy. Explore your potential futures at unchained.com/TBL. I watched the press conference today, and here are some of my key takeaways. The first thing I want to mention is that Jerome Powell was asked, what is the outlook on rates and what is the Fed thinking about in terms of data dependence and how it's digesting data going forward? Powell interestingly said that if we see inflation remain above target where it is today, we can keep rates restrictive. And if we see the labor market slow, we can lower rates. So what is he saying? What does that actually mean? It means that if inflation stays where it is or even gets gradually worse, they will keep rates where they are. If growth slows, they will lower. So there's nowhere in the outlook of the Fed hiking rates. That by itself is very, very important. I'm going to explain why I think that is very important here in a second. But before I do that, why is Jerome Powell only suggesting that they could lower but not raise rates? The reason is something he said later in the press conference, which is that they still feel that rates are restrictive. And so that means, and by the way, that was my outlook behind policy rates coming back down below 4%, which I still believe they are. The reason why I think policy rates still have room to fall is because Powell is telling you himself that the rate where it is here should be bringing inflation down already, that it's sufficiently restrictive where it is here today. So what does that translate into for Bitcoin and for risk markets? Now I want to bring in our liquidity metric, TBL liquidity. This consists of 4 components. Number 1, the size of the banking system. Number 2, the level of interest rates. Number 3, bond volatility. And number 4, the US dollar versus other global currencies. Now, each one of these components drives risk markets up and down. We have aggregated these 4 into one index that has an excellent correlation with the stock market and Bitcoin. What we have created are liquidity conditions for risk markets. What is the propensity for banks to lend and create credit, create money, make markets, and support the expansion of valuations through high degrees of liquidity, money creation, and credit creation? Now, we can measure whether the banking system is expanding or contracting, rates going up or down, and the dollar going up or down. But one of the key drivers to markets, and something we've observed more and more as time has passed, is that bond volatility is a driver of risk markets. And that means when market makers are setting the options market for treasury securities themselves, right now they are showing that there's not a lot of fear in the market. What would cause people to be fearful of their treasury positions? Well, the interest rate going up sends the price down of treasury securities. So what could send rates up? Rate hikes, but rate hikes happen because of inflation and growth. And so the Fed is a lagging indicator. Always remember that. What the Fed does is going to lag what the economy does, and it's going to lag what rates do. So what does that mean? That means rates lead. And if rates lead, then rates traders buying protection, which means buying puts, buying insurance, and protecting themselves against higher yields, right? And so if they buy insurance, protect themselves against higher yields, they are afraid of inflation and, as a result, rate hikes. And so when the market is afraid of rate hikes, it means they're afraid of inflation. They'll go to buy puts. Market makers might step back even because they don't want to sell the insurance, because they themselves are worried also that rates will be going up. That is fear, and that is bond volatility. That is fear from the bond side. We know what stock volatility is. I don't need to break that down for you guys. You're aware of what the VIX is. It's options pricing. People want to buy puts. It sends the VIX higher. Why would they buy puts? They're afraid stocks are going to go down. Why are they afraid stocks are going to go down? It's a variety of reasons, but higher rates is one of them. So higher bond volatility will translate to higher stock volatility as well. But we are not talking about stocks. We're talking about rates. And what is the rates vol situation going forward if the Fed tells you we are not going to hike? We already have rates high. Remember, he said we're sufficiently restrictive. It means we all are already at the upper bound of where we think rates should be. That will calm the volatility in the rates world. And calm volatility is TBL liquidity positive. So if you guys want to know more about TBL liquidity or get the metric on an ongoing basis in our weekly quantitative reports, make sure you go to thebitcoinlayer.com/subscribe. Now, on the other side of what happened today in the press conference and muted bond volatility, which is good for TBL liquidity, you might be curious on an ongoing basis, what are the conditions for risk markets? Well, that is what we are trying to track here. So instead of looking at a level of interest rates by itself, or a level of bond volatility by itself, or a level on the dollar index, DXY, by itself, and then thinking that liquidity is going to contract because of this one thing. No, you have to look at everything together. And actually what we've done with TBL liquidity is now we've normalized it from 0 to 100. So that 50 line gives you a good idea whether liquidity is in expansion mode or contraction mode. Right now, liquidity appears to still be in expansion mode. I want to describe a couple charts here at the end that I'm looking at on my screen to give me that idea as well. So remember that liquidity is a very general term and can mean a lot of things to a lot of people. We are building something very specific to inform us. And that is what drives our framework, is the way that we've quantitatively assembled the market conditions surrounding Bitcoin. And right now, it does look to be like a green light still for Bitcoin. All right, a couple other notes from the press conference. First, Powell was asked about Donald Trump's comments on the interest rate outlook and where Trump wants to see rates. Of course, Trump wants to see them lower because while Trump might not be a student of TBL liquidity, he definitely understands that lower rates will help the risk market and help stocks. And it will help lending as well. And lending will help his agenda. Lending will help investment. And that general idea, I believe, is very baked into markets right now. So there is an expansionary mindset from a liquidity perspective from investors. That is the feeling that I'm getting from the market. If rates remain high or go higher and the dollar gets stronger, yes, it's going to threaten liquidity. But right now, even though the dollar has strengthened, even though rates have gone up, they haven't gone up too much. And we know that they haven't gone up too much because stocks are still doing very, very well. Right now, I'm looking at the S&P 500 futures still above 6,000. And this is despite it being on hold for a little bit, as well as a huge knock on the NASDAQ earlier this week from the DeepSeek saga. We also wrote about that with TBL Thinks. Definitely go check that out at thebitcoinlayer.com/subscribe. What did we learn from this question that was directed at Jerome Powell? We learned that he and the president have not spoken. Now, this is interesting to me for a few reasons. So let's just get into it. First of all, it's interesting to me that Trump hasn't called Powell yet. Okay, he's been in office for 9 days. They haven't spoken yet, and I would take Powell's word I would take his word at face value that they have not spoken in 9 days. So I do think that's interesting. But it tells me that the executive branch is not necessarily interested in working with the Fed and might view the Fed as adversarial at the moment. I don't want to say that for sure. I actually believed, now it's interesting, when Powell started answering the question, he said that we have the public's best interest in mind, and that's how we go about policy. And then he said, with that being said, I've had no direct contact with the president. So it means he hasn't spoken with Trump himself. Maybe their offices have spoken. Maybe there's been a back channel. What it did tell me was that, or I should say, when he started the response, my immediate feeling was that they have spoken and that Powell wants to meet Trump somewhere in the middle and see what the agenda is and find a way to help the American people at large. That was my immediate gut reaction when I heard him start his comment. Then he said, no, I have not had any direct contact. And then I was reminded that the Fed was excluded from Trump's executive order regarding crypto, the digital asset stockpile that he signed last week. So does that mean that Trump and Powell are playing on the same team or on opposite teams? I don't want to assume either is the case right now, and it's just not my position to. So I'm going to continue to watch how this unfolds. If the Fed is able to digest the Trump policies and then come out still lowering rates, then we can see potentially that there's some good communication there. Up until that point, I don't want to speculate any further. Now, what I will say is that the press is obsessed with trying to find something wrong between Trump and Powell right now. That actually has me taking the other side of the coin, that the executive branch is going to at least be heard at the Fed level, and that some of these voters are going to say, yes, we agree with the agenda. Now, if you wanted a straight line through all of this, you're not going to get it, because one of the last things that Powell was asked was about the crypto industry, and Powell confirmed that banks are perfectly able to serve crypto customers. I was watching the tick chart. It sent Bitcoin about 1% to 2% higher in those few minutes after that comment. It is interesting now, coming right after the executive order and the discontinuation of Operation Choke Point 2.0, that the Fed is unwilling to comment on many executive orders that Trump has signed. It's unwilling to comment on Trump policy going forward. But it was willing to comment freely on crypto companies doing business at banks and banks serving those customers. I found that very interesting. The market also found it interesting, guys. So the market spiked on that. I'm not alone here in seeing that headline and grabbing it out. It means that the executive order and the changes at the SEC over the last couple weeks have indeed taken effect already, way in advance of the Federal Reserve having to review executive orders through their legal department. And by the way, the Fed was asked about the DEI programs in relation to the Dodd-Frank law that was passed last decade on bank regulations that mandated some DEI stuff in there. And so Powell has to digest the current DEI executive orders against the existing law, and their legal department has to decide what to do there. Notice that none of that applied to his comments on Bitcoin. It was basically like, oh, Bitcoin, yes, we already have, as a country, tried to move away from singling out this industry. That is a big deal. A couple quick notes on the strategic Bitcoin reserve. First of all, please go watch our episode from this week with David Zell. He talks about the importance of a strategic Bitcoin reserve for the United States, why specifically he believes that it is a sound policy for the nation. An incredible interview, but also some drama unfolding in Washington with Ripple, the Ripple lobby, and some stuff that he wants to share with us next week. Basically, we get the sense that there is a massive attack on the strategic Bitcoin reserve, not from the crypto industry at large, but by the Ripple lobby. This is something that we've tied to the Elizabeth Warren connections a couple years ago. Definitely something to watch out for. So go support David Zell's message and the messaging that they're trying to deliver there. I think it's very important. Second thing is Caitlin Long put out an excellent piece yesterday. I got to read it in advance yesterday morning. And what Caitlin is advocating for is that a strategic Bitcoin reserve be left as a strategic position and specifically not financialized. So one of the things that I highlighted when I was reading that article was the word derivatives. That is basically the key here. If I'm to summarize what Caitlin is saying, as long as the Bitcoin in the strategic reserve are not placed in any derivatives contracts or any leverage of any sort, any lending whatsoever, and most importantly for her, any bailouts at all, it cannot be used for that. It cannot be used as a clearinghouse because that means it's being used for transactions. It cannot be used for bailouts. That means it's being used for banks as well as clearinghouse. for financial transactions. It cannot be leveraged. That means it's being used for lending. So she's saying don't let any of those things touch the SBR. It needs to be a strategic position that the country holds, right? We know that the Lummis bill prohibits any sale for 20 years. Something like that is what Caitlin is also advocating for. So please go check that out as well. A very interesting read. Okay, guys, a little bit of price action here to close out. Now, I'm not going to present the charts today and go through all the candles. Sometimes it can be too noisy. I just want to tell you what I'm seeing out there on the charts because we try to think of things through our TBL liquidity metric. So what is good for liquidity is good for risk. And that means we're looking at a couple different things and trying to judge what are the conditions out there for risk. So one of the charts I want to look at is the 2-year yield as well as the 10-year yield. Now, the 2-year yield seems to be flatlining here around 4.25. Pretty much since November, it's been flatlining. In September, October, it was below 4% on this rapid and swift Fed cutting cycle that only halfway materialized. Instead of 2% of cuts, we only got 1. And for that reason, 2's reversed off of 3.5, and they're now above 4. They're flatlining at 4.25. That's exactly where the Fed funds rate is as well. So it's basically meaning no change from the Fed, and the market agrees with that assessment. On the 10-year yield, it is more dramatic, and that's that fear, the market making that we were talking about, and the bond volatility. There is fear above 4.75 on the 10-year yield, and right now, right about 4.5. It's calm. And so the market, yes, it is on that edge of fear. We're not in this big treasury rally right now where rates are falling, but we are also not in an environment that is screaming fear. So what we take away from the 10-year yield at about 4.5% is that the conditions are stable. And that by itself is very good for risk. If conditions start to become unstable, volatility will spike and it will translate into risk assets. Now, speaking of risk assets, I'm looking at the S&P 500 futures at around 6,000. Yes, they are flat for about a couple months, right? Around the end of November, you had S&P tag 6,000 on futures. It's at about 6,000 today. So yes, the S&P is struggling to get ahead. It's struggling to digest these gains that it's had over the last 2 years, where the stock market has basically gone up by 50%, a huge rally. So where is the next wave going to come from? It has to come from more growth, more optimism, more lending. And right now we are still in a digestion period. So what is the threat? The threat is stronger dollar. The threat is higher rates. And those threats, while they are present, they are not a clear danger. The last chart I'm looking at is the dollar DXY, a hard 10% rally off of October lows, which was the recession fear, and actually the Harris trade. But since then, the Trump trade came back, dollar rallied 10%. It really did cap the stock market there and put a lid on it, and that's still where we are today, but a dollar coming back down a little bit, down about 2% from that peak, and something that we still really have to watch. But I think that the administration is trying to thread the needle with tariffs, preventing the dollar from going up too much. One thing we know is that Bessent, the new Treasury Secretary, who was confirmed, is a student of liquidity. So he is thinking about the dollar, vol, and rates as a sum total for the effect on the stock market, which his boss is obsessed with. We know Trump is going to be tweeting all he can about all-time highs in stocks if he gets them under his watch. Thanks for sticking with us today at the Bitcoin Layer. Lots more to cover this week and going forward, with the working group getting underway and starting to study the potential for a United States strategic Bitcoin reserve. I'll catch you guys next time.